Hello and welcome to another episode of the Student Loan Planner Podcast. I'm your host, Travis Hornsby, and today we've got a major announcement to make. In joining me for this major announcement, I've got Dan Rooker, Senior SLP Consultant and Senior SLP Wealth Partner. How's it going, Dan?
Going great, Travis. Going great.
So this is something that I have long dreamed about. Dan's been doing it a little bit longer than me, but ever since I was handed money by my brothers as a kid to put in the piggy bank, I kind of wanted to help people manage their finances. It was like a long-term dream. But I have to admit that one of the things that scared me away from it is this is really an industry that's really very difficult for people that don't have $1 million already to get started in a way that they're getting fiduciary advice for. So I'll just come out and say it. Dan, along with a few of our other consultants and me, Megan, James, Connor, Sim, and Becca, and others are founding a new financial planning firm called SLP Wealth. Some of you know about this. Some of you don't. Dan is in large part responsible for this because he said yes to my pitch to him to join. So I guess, Dan, could you just share kind of like what we all decided like a few months back, like just how those conversations worked in terms of just we had a lot of people at SLP that had their own firms that were doing student loan planner consulting, and we just decided that like we should just bring it all together under one house and join forces. So could you just give a high level, like just let people behind the curtain a little bit?
Sure. Yeah. So like Travis said, it was a consultants had studentloanplanner.com as their locums tenens in a way. And he allowed us to operate outside of studentloanplanner.com, create businesses, create practices, serve other clients in a more holistic capacity than just student loans. And this year we decided in the spring that the sum would be better than the parts, and to bring everything together and put all minds under one house.
So I think the reality is when you have like a large email list, right? And you put out that you're hiring for a position that, you know, people nerd out on, like student loans. Like people that read my email list are disproportionately people who like to nerd out on student loans, right? So you get amazing people like Dan and Megan and, you know, Becca, Sim, Connor, James, and a lot of the other consultants that you've worked with, by the way, are also joining this. And I think that the cool part about it is everybody was doing kind of their own financial planning stuff, like most people had solo firms. And we just thought about, well, like the average cost to acquire a client for a financial planning firm is like about $5,000. But we have a very large audience. And so if we don't have that huge marketing expense, we can take all that money that would be normally spent on recruiting new clients to a firm and invest it in an amazing client experience. So Dan, could you maybe share too a little bit about what we saw with clients that were sort of being turned away by financial planners or just getting really bad advice in context with their student debt? Just like what are some of the horror stories you've seen?
Yeah, so this goes hand in hand with the types of firms or employers that a lot of us consultants left in the past so that we could go and do it the way that we thought would be best for the people that we wanted to work with. And the people we wanted to work with were the student loan planner audience. So what usually happens, or what used to happen, is I would work for a firm. They had a $1 million minimum or a $2 million minimum, and they said, Dan, if they don't have that much, tell them to come back when they do. And it's nothing against them. It's just all of the other clients that you're working with that we've assigned to you have at least that much, and you would be doing them a disservice by accepting them as a client. You'd be telling them that you're going to pay just as much attention for the money received as the other person who's paying 10 times what they're paying.
So why would they turn them away? Like because like people that are not in the industry don't really understand, you know, AUM fees really, I think for the most part, sure. Right? So like most firms charge, you know, 1% to 2% of invested assets of the firm. So what does that mean in terms of if somebody's invested $1 to $2 million versus somebody coming to the table with, you know, 50,000? Like what does that mean in terms of the fee that your firm would get, and why would that be a reason they would turn someone away?
Right. So however the money is invested, if you have an account minimum to work with a client, and say it's 1%, and that was pretty normal, with a $2 million minimum, that's $20,000 a year. The service model looked like 1 to 4 meetings a year, one of them a financial planning meeting, 3 of them an investment meeting, usually a 30-minute call or a 1-hour lunch. And when a client's paying that much, we would go to where they were. So if the client was in Texas and I'm in Chicago, I'd fly to Texas. And that fee was built into that. It accounted for that. And I felt like working in that capacity was wonderful to experience, but not necessarily the kind of experience that I would want to pay for as a client of myself. So there's that. It was a white glove service, and it was different expectations. If I got an email at 1 p.m., I needed to respond by 4 p.m. And I think that there's a different type of service model that isn't perpetuated, and that's something that we've created that creates a better experience.
Well, I think the reality is if what's the value added by responding 3 hours later to that email, right? There's really not that much value actually. It's more about just like the way it looks. So like if you've ever been to like a bank financial planning office or something like that, right? Mahogany desks, ivory aligned folder that the client is presented to read. I'm just kidding. I think that's probably illegal, but it definitely looks like the graphic design team has run through it a few times, right? One of my strengths is I'm really bad at making things beautiful, but I can get the information out there. Hence the Steel Loan Planner spreadsheet that everybody still uses, even though we have a team of 30 people, and all these people keep telling me, "Oh, you need to make that a software." I don't know. I mean, you can take the wire rim glasses off the guy, but you can't take the wire rim glass personality away. So that's just who I am. So I just felt like we have all these talented people like Dan, that were rocking it with client results, getting tons of savings like in their own individual firms. And it just like you're saying, I think that, if you don't have to hunt for, multi-million-dollar clients, and if instead you have a business model and a fee model that can, work with younger folks, in our case, professionals that currently have student debt or used to have student loan debt, I think it could really be life-changing. We won't fly to your house, but we'll deliver the same amount of value. So it is a white glove service in terms of the value of the advice. Maybe you could share just an example, student loan conversation you had that maybe paid for a year of fees in a month or something like that.
Yeah. Well, so this ties into our fees. Our fees are a lot less than what we were just talking about. And Travis and I are not working on a pile of bamboo sticks. Like, we do have, I guess, a nice work from home desk or something, but we did take this opportunity to redesign what clients should pay for, and then take all of that money and put it towards valuable service. And so our fees, our baseline financial planning fees are currently $99 a month. That's $1,200 a year.
Whoa. Only if you're a podcast listener, and only today. So we're not going to commit to that like long term, right? So we'll tell you if you're interested in this, we'll tell you about that at the end. But just want to throw that disclaimer out there that that they don't necessarily get that anytime they want.
Expiration date. Yeah.
Yeah.
So earlier I was talking to a borrower, and his student loan payment was $2,300 a month, and most of the time it makes sense to wait, to delay recertifying, because you don't want to tell maybe the servicer what your current income is. I'm not sure if that's the way to go. Just depends on the situation. But in his case, proactively getting onto a different income-driven plan was going to save $1,000 a month. And so 1 month of student loan payments later has paid for almost 1 year of financial planning fees at the current.
Yeah. And we see this all the time. Like, that's why we have 15, 16,000 SLP clients or something like that. I mean, it's, people definitely trust our student loan chops. Now, the question would be, if I was somebody, I'd be like, well, how do I know about your financial planning chops? Like, how can we know that the student loan knowledge is going to, carry over to financial planning, right? So maybe a couple of thoughts about the pricing real quick. So the $99 a month rate, right? It's usually $199 a month with a $1,000 setup fee. For podcast listeners, it's only $99 a month with no setup fee. And you go to slpwealth.com/book. We'll share more about that later. I think because I read the slpwealth.com/book, I've got to say the annoying disclaimer. So SLP Wealth is a registered investment advisor with headquarters in Durham, North Carolina. This is not an offer to buy or sell securities, and all investments come with the potential for loss. Consult with a licensed financial professional before making any investment decisions. That was my effort at speed reading that. So the slpwealth.com/book, like, what is that about, right? So we do also do investment management, but the vision, right, Dan, and you're pushing me on this in terms of 401ks, but the vision is to literally offer everything under one roof, and you can pick and choose. If you'd rather not use this for something, that's totally okay. Because we have volume, we don't need anybody's business on one particular line or at all. And the thing is, you might say too, how does this affect Student Loan Planner? Like, what about Student Loan Planner? It doesn't affect it at all. We're still leading with our student loan consult service for people that need that. You need to do that first, really. If you want to work with us on the SLP Wealth side, it's better to just get your student loan plan first. Now, the reality though is, say you have your student loans forgiven already, or say that you have read all our content and really feel like, on the student loan side, maybe you have 40,000 of loans or something and you don't need that much help, but maybe on the financial planning side, you do need a lot of help. So we're not going to, police this hardcore, but people should get an SLP consultation first if they need one. That's studentloanplanner.com/book. And then you could go to slpwealth.com/book if you wanted to sign up for financial planning. And you could skip that first step, obviously, if you have no student loans because maybe they were forgiven or something like that, right? Mm-hmm. Now, in addition, there's a 0.49% fee of whatever we manage directly. So just a little bit about that, right? So there's, a lot of conversation right now about like flat fee advisor, AUM's evil, or like, there's a lot of different debates about this, right? So I guess,
but I'd like to take it back, Travis, to the market norm out there is 1 to 1.5%. And
right.
The 1.5% fees have account minimums, 250,000. The 1% fees have account minimums of usually $1 million. We're doing half or less of that and doing it with no account minimum.
And we're talking about the fees first because that's the kind of the yucky stuff. Like we want to get into like the value of like what does that actually get you? Because I think what a lot of advisors do, Dan, is they just sort of like, I don't know if you golf, no offense, but like they hit the golf course, right? They like pick 16 funds out of their model portfolio to make it look really complicated. They maybe have a little tax loss harvesting, but probably don't. And, and they make sure their reports come lined in, mahogany or ivory. I don't even know something smart to say about that, but it's, it all looks very fancy, even though there's not a lot of actual value in some cases being delivered. Now that's not for all planners. Some planners do an amazing job. Some people have a great process, do great work, but they do the intro call with you and it's free. And then they find out that it's $8.99 a month and it's a flat fee. Well, I've got news for folks, right? Run the math on 99 plus 49 basis points, whatever you're planning to invest for the next 10 or 20 years, compared to a flat fee that's $4.99, $5.99, $8.99 a month, and that's a better deal to take the alternative. Because the one thing that's lost, I think, in these discussions of what do you pay a financial planner only earns a fee if it's over the very long term. During that very long term, if you're a multi-millionaire, there's a thing called breakpoints. Breakpoints is where your next million or your marginal $1 million is charged at a lower AUM fee than the first million, right? So that's pretty common practice in the industry. And so what matters is like, what is your overall fee you're paying for something? That's really what it is for anything. You want to be looking at like, what's the total cost more so than, and is that total cost that I'm paying very problematic, like in terms of incentive structure, right? Like if I'm paying my advisor only for commission-based products, that's a problem because everything's going to be or could be a product, right? That's the temptation. So I don't know. I mean, like that's kind of one of the reasons why I disagreed with like the way some places were doing student loan advice back in the day. They would do free student loan consultations, but make all their money when people told people to refi. Well, what's going to happen when somebody's a marginal case to refi? They're going to pitch, you should go refinance your loans, and it could cost you a lot of money, right? Yeah. So that's what, I don't know. I mean, I think, we talked about this, like, this fee stuff. I think that's really not that impressive compared to the results we're getting clients right now. Or that's not even that important compared to the value we're getting clients. Because I think what you're going to have happen, right, is anybody who listens to this who's remotely interested in this, if you shop that fee around other places, we're going to come in cheaper 99 times out of 100 in terms of, other any kind of peer advisors that have a dental group, a lawyer group, a physician-specific group. We have those, by the way, vet-specific group. We've got a nonprofit government type of group as well. We're building out additional profession-specific groups because, when you talk to thousands of people in one profession on their student loans, you learn some things about how to manage dental practice or how to, do depreciation for certain types of things or certain issues that physicians come up in with contract negotiation. So let's talk about the value a little bit, because I feel like,
Sure.
People hear fees and they think, well, shoot, Vanguard's only 5 basis points. I can do this myself, right? So let's talk about for a moment something we call the 3% rule. It's not the 4% rule. That's retirement related, right? That's the FIRE movement. But the 3% rule is something I just made that name up, but it's about a Vanguard study that found that financial advice can add 3% net returns over and above what you'd get on your own. And so the first 1% of that, we're going to break this out into 3 different parts of how do you get to 3% outperformance, and then subtract whatever you're paying your financial planner, and that's your net expected outperformance, right? And again, I have to say no, past performance, no guarantee of future results types of things, right? So in terms of the 3%, breaking it out to 3 parts. So that first part is tax-aware withdrawal strategies, and just in general being tax-aware about your investing. So let's say someone's a DIYer, Dan, and they have a vacation house. You ever had clients buy a vacation home or something like that?
Just a couple times.
Just a couple times, a few times, right? So what is that in Chicago? Like a Lake Michigan house or something like that, like on the lake?
It's probably a house on the Lake Michigan side. It could be Lake Geneva. It could be up in Wisconsin. Bunch of lake houses.
Or I mean, if you're making like 150K as a household, it might just be like a small cabin somewhere, right? It doesn't have to necessarily be a $500,000 or $1 million place. So you probably need a down payment in a lot of cases of 20% for a second home, right? So you got to get the money out, and usually people don't have that much money sitting around in a checking account, so they got to go to their brokerage account and pull it out. So let's say you're a DIYer, you go to Vanguard, you've been investing for a long time, and you pull out $100,000 for a down payment. And what would you guess people would do in terms of like what accounting method they would select for that?
I think they would select the default accounting method.
Right.
Probably.
Yeah, probably, which is average cost at Vanguard, right?
Mm-hmm.
So if you've got, let's say you've doubled your money over time investing at Vanguard as a DIYer. So then you're going to, let's say you have $200K in your account and half of that's a gain, and you go and you sell 100,000, right? So they're just going to look at your overall gain is, basically you doubled your money. So they're going to look at selling 100K as, okay, well, 50K of that's going to be original investment and 50K of that's going to be gain. And so we're going to tax you on a 50K gain. Now, what you can do instead is do specific lot identification. And that's French for pick the stuff that gives you the lowest taxes when you sell. So you can literally go in and, and check each one of the different lots you want to sell at Vanguard. Now,
think about what you've been doing. These lots appear every time that you save into the account. Every time you have a paycheck or a monthly contribution, you're purchasing that index fund or that ETF at that price point that day. And so you have all of these transactions over time, which result in all of these different price points, which you can select from, or you can choose the default method, which could cost you money in taxes.
Well, yeah. And you can also select different methods. You can select last in, first out, which would probably, but not always, give you a lower tax bill because you're selling stuff that probably the price of the stock you're buying now is probably higher than it was 10 years ago, right? So there are some things that DIYers can do to select a better cost method, but most people are going to hit that default button. And once you've sold it, like, good luck changing it. So, if you've got 50K of a gain and you're in a state like any state that's got a 5 or 6% income tax, you're going to pay, depending on your income bracket, 15 or 20% plus 5 or 6 for state, more if you live in New York or California. And so let's just say you lose, 25-ish% of that 50 grand. So that's about $12,500. So that would pay for 10 years worth of SLP wealth, maybe. So that's one example, just a kind of a hypothetical example. But there's a lot more when it comes to withdrawal order and withdrawal strategies. Do you pull money out of retirement? Do you pull money out of your brokerage? Sometimes it actually makes sense to, get income, like strategically get income on your tax return. Like if you're using the ACA plan, a lot of people don't know this, but if you hit like right around 100 to 150% of the poverty line, if you're like in between jobs needing to the ACA plan, you can get copays in some cases as little as like $5 a copay with like a few $100 deductible because of like cost sharing assistance. And so you might say, well, how would I invest? Like, how would my investments relate to that? Again, what do you want your AGI to be? You could generate like all kinds of like loopholes and just like do like strategic rollovers of certain amounts from your traditional to Roth accounts to generate an exact AGI number. And in the SLP consult side of things, we don't really talk about this a whole lot, just because our job is to like deliver savings in the student loans. And I just got like, I don't know. It's just like, we just want to share this with the world, Dan. What can we say, right?
And we're not talking about things that happen in retirement. We're talking about an expenditure for something, whatever you name your big ticket item. Could be this rare chair that you want to get in the house. Could be an entire house. Yeah, I did have a client who wanted to buy a rare chair. So large ticket items. If you're pulling from your brokerage account, we're not talking about things that happen 30 years from now. We're things that happen in the next decade.
Yeah, I mean, so that's tax-aware investing. So we think that probably adds about 1% long-term in performance. Now, the second part is tax-loss harvesting. So what that is a funny-sounding term, tax-loss harvesting. What does that mean? So, like, stocks go up and down, right, Dan? They tend to go up and down a lot. Some years they go down more than others. And so when you have a really down year, a buy-and-hold investor, which the vast majority of DIYers are buy-and-hold investors, right? They just buy it and forget it. The reality is if you're not doing any tax loss harvesting trades, what you're doing is giving up the opportunity to capture a bunch of losses that you can then go offset against future stuff that you sell. Now, if you're a business owner, you could potentially benefit from that, right? If you're somebody that might sell a very valuable house one day, you might benefit from having a bunch of losses that you could harvest. Now, the way this works is, when you're invested in something, you sell something and buy something that's almost the same type of investment, and then you swap back. So that's basically what it means. Like, you wait for something to go down in value, buy a replacement that holds for 30 days. You hold it for 30 days, and you swap back, and then any kind of loss, you get to use that, and you can first use $3,000 a year to write off against your active income, which for most people probably saves them about $1,200 a year if you're in a 40% bracket. And then any unused losses you can carry forward to future years. So this could really mean enormous savings for anybody with, anything significant one day that they might sell. And then you might say, well, isn't that just putting off a tax liability you'll have later? No, because you can use that strategy in conjunction with something like a donor advised fund to just donate like appreciated shares that you might have from tax loss harvesting directly to charity, get the write-off for the capital gain, and get the write-off for the full deduction. So what we saw, is sort of like a massive lack of like fiduciary planning that was at a very high quality level in the space of the, 20s, 30s, 40s, 50s somethings that are not people with $3 million in retirement that, everybody always gets marketed to. So we just thought, like, given that most of us are in that that age, starting families in some cases, just going through a lot of the pain points that a lot of our clients are going through, we just kind of thought this was going to be really kind of a cool idea. So the tax loss harvesting, that's 1%, we think, long term. There's an MIT study that suggests it's like anywhere from 0.8 to 1.2. So far, we're 1% value add for tax-aware investing, which most DIYers will not do on their own. Tax loss harvesting, which most do-it-yourself people will also not do on their own.
I got to comment on that piece of it. Like,
sure.
Tax loss harvesting, in practice, at large firms or private wealth management firms, in practice, it happens quarterly or monthly at most, or when there's a big market scare. That's when the trading team goes in and says, should we do tax loss harvesting? What's happened in the past decade is there is technology that allows you to do tax loss harvesting in a more automated fashion. And that's something that just hasn't been adopted in our industry at a large level because of perception, because of not wanting to make it look like there's churn in accounts or day trading going on. And we're not talking about day trading, but it does require a daily look at the account if you're doing it right.
Well, and to be clear, like we think that too, most of these firms, so a little look under the curtain again, most people in the financial industry use like very established old players that manage the money in the back end. So there's a thing called custodians, right? When you invest with somebody, you don't give the money to me and Dan. It's not sitting in our pockets. It goes to a third party called a custodian. So a custodian is an SIPC, member that's got up to 500,000 of coverage and probably has reinsurance on the rest of it, like through Lloyd's of London. So it's sort of like a brokerage account. You can think of it like that, but it's a brokerage account that is working with financial planners, right? Financial advisors that have discretionary authority and are licensed to make investment decisions and take investment actions on a client portfolio, right? So we think that there's been a lot of innovation in this space recently. And if you're a firm that's got hundreds of millions or billions of dollars in AUM with a bunch of 60, 70-year-old clients, you're not going to move all them to a new option because of how hard it is to move client portfolios from one reporting system to another, right? Because you can mess up cost basis information, you can mess up all these things where they just don't want to move. And so then they still are trying to get that $3 million client that's 65 years old. And meanwhile, there's like these options that like stuff that's just never been available to people before, like from financial planners. Now you might say, well, what about like robo-advisors and stuff like that? Well, we'll get there. First of all, the robo-advisor is not going to help you with the tax-aware investing across your whole portfolio, right? They're not going to know how to do that because it's a robot. It's not one-on-one financial planning. And then the tax loss harvesting thing, sure, they'll do that, but guess what? There's also something called the wash sale rule, which if you don't tell your robo-advisor that you have to have a play money account or you have a Roth IRA somewhere that you didn't disclose, or you have some sort of other account somewhere, if you buy the same security that you did the trade in, it completely disallows the loss. So even like tax loss harvesting for a robo-advisory firm, which is a much better value than most financial planning firms out there, it's still not getting you that full value because they're not looking at your whole picture. They're not having conversations with you, so they're not able to give that holistic advice that you need to get that full return. So tax-aware investing 1%, tax loss harvesting 1%, and then the third plank was essentially like avoiding big investment mistakes. So so there's I think he might even live in Chicago, Dan. Dan's a Chicago guy through and through. But there's I think it's Richard Thaler invented behavioral economics, or I guess popularized it, won the Nobel Prize for it, and essentially identified that like we as investors and just humans have all these behavioral biases that we're subject to, and all of us are subject to them. So it's things like overconfidence bias, anchoring bias, endowment bias. So what does all that mean? So endowment bias is like if you own something that you'd rather you just want to keep owning it, even if it's kind of irrational. Overconfidence bias is everybody thinks they're a better investor than they actually are. This is true pretty much for everybody. No offense to our male listeners, but especially men. That not to say that it's it's gender specific. It's everybody is potentially prone to this, but overconfidence bias is something that is very real. And there's also hindsight bias. So a lot of people, when they look at performance, they'll look at a fund that is one ETF or one fund or asset class has been doing really well. They'll look at something that hasn't been doing really well, and hindsight bias like overweights that past performance, because looking forward, the reason why all these people want you to say past performance is no guarantee of future results is because a whole lot of times it's not even close to what it looks like in the past, right? Like you have a period of the 90s where tech booms, and then you go through a period where it slows down a lot, right? You have a period where international stocks like Japanese stocks did amazing in the 80s. Everybody's writing articles about why you should invest in Japan, and then the Japanese stock market falls 80-90%. So a lot of part of a financial planner's job is to help people look out for that big financial mistake that you're going to mess up. And a lot of times it might not even be like an investment thing per se. It could also just be like setting up an options trading thing without realizing the tax reporting like you're going to put yourself through, or like setting, something with crypto where you're not realizing the tax implications of what you're going to be doing, or screwing up a small business retirement plan form that you're supposed to submit and incurring a lot of penalties. So I think that so that's probably about 1% as well, just avoiding these big mistakes. If you add up 1 + 1 + 1, it's 3%. It could be more than that. There's other technical stuff that we can get into. Like we have an investing course, and that investing course, I deliberately keep it simple. But if you're having a professional manage your portfolio, we have this strategy called cake plus icing. So the cake is like the broad investments that will be delivering the majority of your return. And what we do is we add a few what's called asset classes on top of that add a little bit of like positive risk adjusted performance, we think, long term. Not something crazy. Like, we're not trying to swing for the fences at all. This is just something that if a professional is managing your portfolio, you might do it a little bit differently than if you know somebody's going to be putting money in themselves, because you don't want to get somebody needlessly like confused. And there's probably very likely going to be, risk adjusted outperformance from just having a few more asset classes added to the portfolio. So we think, could be as low as 1% outperformance. If, you're talking to somebody that already does a lot of this stuff for themselves, could be as much as 4%. Can't guarantee that, of course, but if you take that range of outperformance, potential outperformance, I should say, and subtract whatever the fees you pay are, then whatever's left over is the value you're getting. So I guess, Dan, my view is, like, in the industry, the reason why a lot of financial planners get such a bad name is if you're charging a 1.5% AUM fee plus trying to put people in a bunch of active funds, like, usually it's like 10, 15, 20 different funds with weighted average expense ratios of like 0.5 to 1 themselves. So if you're eating up, 2.5% in returns, you also have to be doing all the stuff that we mentioned to get that outperformance, and most advisors don't, because it's all about just more clients, right? Because it's so hard to get clients in the industry. And so you're sitting there with probably a negative expected performance if you've got an advisor that all in is 2.5% in their fee plus the fund fee, and they're only delivering 1 or 1.5% of that 3 because they're not doing all the things we mentioned. So there you're sitting with somebody that's delivering net negative value to somebody. So yeah. I don't know. I mean, what are your thoughts on the value that advisors add as a group?
My thoughts are that out there today, there's still a ton of people that happily pay these fees when it's a net zero relationship in a sense, and so what you have left afterwards is relationship. That's why they still pay those fees. Is
right.
They trust
family
their
friend.
advisor, family friend. They trust the financial planner they're working with, and maybe they're still okay and they feel good about it. But what we're trying to do is capture some of that, maybe that 2% difference, and kick it back into total return for you, the client. And I think that changing the service model, challenging the rest of the industry to do it better, is part of our goal. It's part of our mission.
And let me say this too, right? There's probably somebody here, some financial planner listening to this, that's thinking, oh, bleep, I used to send all my people to SLP, and now I'm terrified that, I'm going to lose all my clients that I refer to them. I shouldn't refer anybody else to SLP or something like that. I mean, we have very much an abundance mentality, right? We think there's so many great financial planners out there. There's a ton of good options that if every single one of us got hit in an asteroid strike, we would be very happy with you working with, a lot of these people out there, right? We think that fiduciary planners, by and large, are a great group, and we're not at all saying that you should leave them and join us or something like that, unless you feel like you're not getting value from that person, right? I think that's the reality. Is like, if somebody's getting tons of value from their financial planner, maybe the $5.99 or $8.99 a month fee is worth it. Maybe that's a valuable investment. I think that what we see is, like, just over and over again, just so many people being turned away from fiduciary advice because they don't have enough money yet. And also a lot of like fiduciary planners desperate to hold on to clients, trying to not have clients referred to us for student loan advice because they try to DIY their own student loan advice because they're terrified of losing a client, because of what I mentioned earlier in the pod, where the average cost to acquire a new client is like about $5,000. And so it's just a huge loss to lose a client. So a lot of times people that are not as confident in their value are terrified of losing a client to somebody else. But I think that we're all trying to say, how can we contribute to the industry? How can we be a solution instead of part of the problem? And I guess it's okay to say this. We've only launched this in a soft launch so far, but we have, I think, something like 600 to 700 clients already. So it's like, in terms of growth rates, would that be fair to say, Dan, that we might be, I don't know if that's how good that is.
At the very top of I've ever seen. Yeah. I was blown away. And it's been a great ride. And I think that what it's challenged us to do is do something that other financial planning firms haven't had an opportunity to do, and that is pivot with the feedback we get, which Travis has been very good at, is getting feedback from other people. And I think also this is something else. We may not know everything, but you are probably talking to a certified financial planner who has seen a lot of transactions, and that's the benefit of working with a financial planner. That's when someone asks me what is the value of working with a planner, I think it's in the number of transactions they've seen. So that doesn't mean that they are much older than our average age. That just means that they've seen a lot of things. I may personally purchase 1 or 2 homes in my working career to live in, but I've seen hundreds of transactions vicariously through clients. And every single one of the people that work on that side has experienced that on the student loan side as a consultant, and has or will experience that on the SLP Wealth side.
And I could say that as the resident, I don't know, as the resident, been through everything in terms of financial stuff. So I've pretty much set up all the different types of business corps you can, all the different types of LLCs. I've gotten all the different types of surprise, like, oops, I didn't know about that penalty, or like, oops, I didn't know about like that mistake, in terms of just as growing from a business owner that had just me, right, sole proprietorship, to growing to like an S Corp LLC, and then LLC tax as a C Corp, and then having like 5 different or 6 different LLCs, and having, that massive income growth too. I want people to know this. We're also going to be very well equipped to serve you if you're extremely wealthy one day. So we want to be able to be accessible for the like most modest income social worker out there at that $99 a month rate, plus that, sort of like the hybrid fee really allows us to serve that client where that could be in somebody's budget if they really want financial planning, right? Now, maybe that person making that 30, 40K wants to put off planning until they get, maybe they get married or have a long-term partnership or something. And then now they're, maybe 2 social workers together can more easily afford that $99 fee. So, but the thing is that was our big goal, is like to be accessible to that group, but also be able to serve people if they're very, very wealthy, right? So, yeah. I mean, I think that that's something that we're going to be going down a rabbit hole of like multiple different service offerings in the coming months. We are starting a tax business, which we're going to talk about next week a little bit. And the thought process behind that is there's tons of value in the tax planning space, both within student loans and outside of student loans, that's not being addressed. And we just sat through this presentation, Dan, with the provider of like tax planning software. It was really great. I mean, it was basically like, you can't afford this level of tax planning knowledge unless your clients are making over $500K a year and they're paying you $20,000 a year in fees. And I'm like, we have 6 figures of people on our email list. We can figure out like systems and processes at scale that other people can't, because they have to go run a bunch of expensive ads and VC fund themselves to do that. So challenge accepted. We will prove that we can profitably serve a bunch of people that need to save 10 grand by setting up S Corps, or save money on their student loan recertification by putting it off for an extension, or whatever these different strategies that we'll talk about in later in next week's pod and the following pod. We'll talk about some of this. But the thought process is just like so many people come to us and say like, you were the first place that was able to help me and make me not feel like I was nothing, financially, and it's not because we're super special. It's just because we knew the rules and we have just a heart for our clients to really care about, helping student loan borrowers. I think that's part of it, right? Like, Dan, you used to manage money for like what, like centimillionaires in some cases or something. I mean, it was your clients were extremely wealthy at the firms you worked at previously. Yeah.
I mean, the last firm I worked at, I think, is closing on $120 billion in assets under management now. But and I think that there's a difference between having a conversation with someone who you knew didn't meet the minimum, because in the back of your head you were thinking about time and billable hours, and I don't think that anymore. I'm just thinking, and I think that everyone on the SLP Wealth side thinks the same way. We're getting paid well to talk here, and at scale, it's going to be great for everybody. There's no, this client doesn't meet our minimum, or they're segmented at a different level. We just think everybody coming in deserves exactly the same level of care.
So we always get in trouble whenever we like make a medical analogy because we're not medical professionals, right? But the thought process too is like when a lot of our people that came to Student Loan Planner do become consultants, might have been doing student loan related stuff on their own before joining us, and maybe because they were interested in the space, it makes sense, right? And a lot of those people were doing like 4 separate 1-hour meetings to go through a student loan plan with someone, and like because of scale, because we have so many clients that go through our system, and just because we see so many more things, we're able to go exactly to the problem in someone's situation and fix it all in the 1 hour with one meeting, right? And so what we've been finding so far, so it's not just we're launching this, we do have many hundreds of clients now. And like what we found so far, Dan, maybe you can speak to this a little bit, is some firms have this very long drawn out process of delivering a plan over like a 20-hour series of meetings. And part of it is because maybe they would say they're providing value, but part of it also is to make it look like it's tons of work and it's you've got to justify the $15,000 fee. And our approach is just like, let's surgically go right to the problem area that we find and start delivering value immediately. So that's why we don't do intro calls, because we don't need to. I kind of frankly think it's a waste of time, like because you can cancel any time if you want. So our process is just sort of like, if you want a book, go sign up, fill out the form. The very first meeting, we're going to be drilling into, how we work together and just making progress right away. So it's a very different way of doing things. And I think that's been, at least from my observation, one of the key parts of this being successful so far, at least.
Yeah. Yeah. I mean, I think that if you go and you shop around, comparison shop, what you'll find is, you'll find several kinds of financial planners, but what Travis just mentioned, what you just mentioned was, if you're doing it by the book as a certified financial planner, you do a prospective meeting. In the prospective meeting, you just get to know the client. In the next meeting, you propose based off of what you found out, a scope of work with them. And maybe between meetings, you ask them to fill out some data form. Well, those 2 meetings we've condensed into one, and the proposal is already accepted. Now, in that former situation, I've done this many times, you get to the proposal and it's almost like the financial planner just fills in a blank and says, this is what I think my time is worth for the scope of work over the next 6 months. And that's fine. They can insert whatever fee they think works. And it was usually between $5,000 and $15,000 for a 6-month engagement. Half up front, half at the end, like working with the general contractor. And at the very end, when you write that last check for delivery of the plan, when you've met every 2 weeks to get really dialed into your financial plan, you get a PDF or a document, a book, and this is your financial plan. But there's no implementation. There's no hand-holding. The relationship's over. And we turned that around and just said, let's start with implementing, because if we did spend all this time and money into creating a plan with the client, it's going to have changed by the time we get to 6 months from now.
Yeah, I mean, and the implementation is where the real value is, right? So even the most hardcore DIYer is like prone to making a mistake about doing some sort of random thing they were supposed to do, and then they forget because there's no accountability. So, for example, filing Form 5500 when you have over 250K in plan assets and a solo 401K, you got to file a Form 5500, or the IRS will penalize you something like $250 a day. I wish us all. That adds up in a hurry. So I think we're joking because this happened to me. So the problem is like DIY has some serious consequences sometimes that you're just not aware of until you find out the hard way. There's I don't know. There's just lots of examples that we could go down with the rabbit hole. But I think that people know us, and I think some people will still think I can do it myself. I think that probably 1 in 4 of those people are correct, and 3 out of 4 of those people are probably suffering from the behavioral finance bias called overconfidence bias. And you know what? It is your right to do it yourself. If you just want to do it yourself and you're okay with performing possibly less well than you would do with a professional because you just feel better about it, that's okay. Again, there's no pressure here. I just think that, for so many years people have asked us to do it, and some more behind the curtain stuff. If you don't get to a certain number of clients, then you have to be regulated by the individual states across the country. So if you don't reach a very large number of clients very quickly, suddenly your time is now spent answering individual emails from I won't name any states in case I upset someone, but, pick a random rural state that a regulator has tons of time on their hands and they want to know about the size of your filing cabinet. And I wish I was exaggerating, right? So for me, I just thought about is this how I want to spend my life? No. That's one of the reasons Student Loan Planner exists, frankly, is because I saw all the compliance rules for doing financial planning. And I got sick to my stomach just thinking about that stuff really makes me very sad. So I was just okay, SLP I can do in a way that doesn't have to, be registered as an investment advisor. So we're going to do it this way. But the problem with that, as I noticed, that a lot of times, Dan, we would recommend something from a consult and somebody would do a follow-up consult with us a year or two later. And, oh, look, the thing that we told them to do isn't done. The consolidation that we recommended didn't happen. Why?
A lot of times for small reasons, not big reasons, just worry over capitalization of interest or things that we covered, but they forgot. Yeah,
and it just fell off by the wayside. And so, basically Dan pitched us on using some software tools that help advisors remind clients to do certain things, move over that troublesome retirement plan from a workplace employer years ago that you've been meaning to get rid of, or, roll over your traditional IRA to your workplace plan so you don't suffer from the pro rata rule when you do a backdoor Roth, right? Or, check in with your tax professional to make sure that you're filing, taxes the right way this year, right? So that's the other bit of value. That's why you say, why is there a monthly fee? Well, it's because it's value being delivered year round. And I think that, we have some clients that use this for the full suite of services and some clients that just want to have that recurring financial planning and no other services provided. And we're okay with whatever people want, but we just wanted to be able to do taxes, financial planning, investment management, possibly retirement plan management as well at some point. We can already do that for small business owners that need a solo 401k, right, or a SAP IRA or something along those lines. But we're even getting into at some point probably being able to help a dentist with a few employees manage a 401k plan or set up a 401k plan. So
I'm really excited. I mean, by the numbers, forget investments under management, forget fees being charged. We're able to work with a lot of people by firm size, by number of clients in the past 6 months, the amount that we've grown, and just imagining where it's going to be in 5 years, we're already a large firm. And just seeing where we're going to go in the future, that's going to be good for a lot of different things, just the spheres of influence that SLP Wealth will have over time through the client base is huge.
Well, and we did a survey of our existing clients with SLP Wealth just to see where the pain points were, because we're trying to rapidly iterate to make the best financial planning experience in the industry. And our average advisor rating was 8.4, and I was 8.4, that's not high enough out of 10. Let me go see why. And the number one complaint that we got, this survey was done around October, was just advisor availability at that time wasn't super high. Because we messed up and we had some advisors have schedules opened with SLP and then also SLP Wealth. And so a lot of our core starting SLP Wealth advisors had a bunch of SLP meetings booked. And so there wasn't as much availability on the SLP Wealth side for the follow-up meetings that needed to happen. And so we got that fixed and we've tripled the size of the team now. So we do have plenty of advisors now that can serve the capacity, which is why we're talking about it today instead of not, instead of earlier. And so, that's going to happen with anything. You will have issues that pop up as something grows quickly. But the exciting thing that I think that we're doing with this growth is if somebody does want to hire us as their financial planner at slpwealth.com/book, the experience you're going to get is you're going to answer your profession and it's going to redirect you to the right booking link for your profession. So we actually have dentist-specific financial planning. We have physician-specific financial planning, veterinarian-specific financial planning. Our vet team is actually led by somebody that used to be a veterinarian. That's insane. We have other profession-specific planning groups too. You're not going to find value like that anywhere else. And the reason we have those groups is, we see trends from 2,000 student loan plans we've done for dentists and have countless conversations about buy-ins and purchase prices and transaction prices and just making sure that you're, not getting taken advantage of by your PPO plan, right? And, all these different things. And we can go deep into profession-specific stuff as well as high-level financial planning that would apply to anybody. So that's I mean, I just think it's just going to be like the value is just going to be like coming out of a fire hose with this. I'm so excited about this. Like I haven't been excited about something like this since I built a spreadsheet 7 years ago and realized how much money people could save by optimizing their student loan plan. I think it's like, I used to be a little bit more hardcore, Dan, that DIY was a pretty solid option for somebody to do. And I think that what's pushed me over the edge is like availability of increased tools that can make a lot of the stuff that very wealthy advisors get, like brought down to people that make, 6 figures but don't have those 7-figure assets yet. And just like a lot of the stuff I've learned about taxes being a business owner, like that thing really pushed me over the edge. Just realizing as a business owner how many tax mistakes that I've made, the CPAs that I've been through learning things. And just, so if you're, W-2 person, you can still save a massive amount of money even if you never become a business owner. But I think I just had that overconfidence bias, frankly, that I was only living this limited experience, seeing what I knew. And now I know so much more about all the loopholes and stuff that are available. And, for 80, 90% of people, I think you'd benefit from working with a planner. And if you comparison shop, I think SLP Wealth will be the best value for the money.
Mm-hmm. Yep. And I think that the person that you're working with, the mindset of the people and the group that you've joined, if you're a client, is just going to be different than what you find out there. There's no mahogany tables, but we're just, we're working on things together, and we're also going through a lot of these life experiences as well ourselves because we're at that age.
Yeah. So the next step is, if you're interested in this, again, SLP, so Sam Larry Page, like student loan planner, right? slpwealth.com/book, and just it'll answer your occupation and it'll take you right to the booking link. And for podcast listeners today, we want to say today because some people listen to the podcasts later down the line, and if you see the link being live where it says $99 a month in the advisor agreement, then the deal's still live. But we just don't want that to be a permanent promise or anything. But if podcast listeners today can get that service for, starting at just $99 a month, and I say starting at, again, to protect myself from, I still have people, Dan, that will find some article I wrote in 2016. It's like, look, you say you do student loan, you do student loan consults for a Cracker Jack box and 50 cents. Here it is. So anyways, I think hopefully people will book that if you're looking for a financial planner. I think we'll deliver exceptional value. And then you might say, well, whoa, what if I need a student loan consult? Student loan payments have started again, etc. Again, if you have not gotten a student loan consult from us first, get that first, and that's going to give you a lot more, just confidence in moving forward on the financial planning side, because the financial planning side we're doing, it's everything, right? And we're for purposes of just making sure we're a good fit, you might want to start with that student loan consult, and that's studentloanplanner.com/book if you need to just schedule your 1 hour, flat fee student loan consult. And if you're already a client, or you have no student loans because you listen to our podcast and got them forgiven thanks to this great advice, we've got a lot more in store for you. So slpwealth.com/book, and then I'll close out with this really annoying disclosure. SLP Wealth is an SEC registered investment advisor with headquarters in Durham, North Carolina. This is not an offer to buy or sell securities, and all investments come with the potential for loss, and consult with the professional before making investment decisions. slpwealth.com/book. Thanks, everybody.